Well, guys, how are we all doing? I am Dan from Trading with Dan. How are we all doing is probably a somewhat rhetorical question, given these current circumstances. I even have a coffee with me here in my my nefariously acquired Costa coffee cup here. So just have a sip of that coffee before we look at some disgusting charts. So firstly, we shall go up to what is pretty much the problem, the issue that we have going on here, and that being obviously stock markets. Stock markets are getting trolleyed, they're getting trashed, they're getting whacked, they're getting hammered, they're getting wrecked, whatever term you might want to go with. You can see we're having a pretty aggressive move down. If we want to have a bit of hopium here, then what I would look at is that we had this quite convincing trend line guiding us up for a while here. When we broke it, we kind of back tested it, we came lower, and then we continued up, and then just sort of continued higher with a not quite as aggressive trajectory as we can see, hitting the underside of that trend line again if we extend along here. In a fashion, we now then established a lower trend line for this price action here, of which we then did break below. Obviously, most recently we did break below, and then so in the context of that, if we then put in a higher low relative to these lows here, then we can potentially get another run to the upside in what is potentially a GAN fan. If you guys know what GAN fans are, you have like sort of this trend line, and then we'll have potentially a new less steep trend line that will then ultimately govern the lows, guiding us up in obviously a less aggressive fashion. So if obviously this underside here, if you want to extend it, being the level that kind of rejects price action getting above in the next iteration of bullish price action. That is basically what I would say, in my humble opinion, is the most likely scenario for stock markets, on the basis that we will only realistically have one big crash where we're out for the count, and picking any particular point of being that big crash is not probable, basically. So it is more likely that the market resumes onwards and upwards like it always has done forever, basically. So yes, we are obviously having a lot of rotation out of growth to value, and obviously there's a lot of money in value, a lot of speculative money, in growth, a lot of speculative money in all these crazy tech stocks, which are quite notably getting whacked at the moment. So ultimately what will happen is when you get rotation, we'll end up with new market leaders, and then we will right the ship, steady the boat. The market leaders will then start to drive the price upwards, whilst the stocks that are getting rotated at will underperform the market, and then we will then continue with a market a bull run based on obviously the new market leaders. But in that process, we can clearly have volatility. Maybe the people that like to invest in these speculative crazy financial stocks are the not necessarily the sort of people that then want to do like an actual real professional's financial decision to then rotate into value, because nobody likes value. Value's not exciting. Utilities, oil producing and service companies, they're not the sort of things that people really think are gonna they're not gonna do like a 10x or whatever. So obviously if that is going to happen, that money can obviously come out of the market, not necessarily find its way into growth, which will ultimately have an overall drawdown to the market. But at some point that will bottom out. New market leaders will drive the market onwards and upwards, and then we will continue in the same way that we do. Don't forget, these are indices, they have to go up, because when an individual companies aren't doing so well, they drop out of it and new ones come and replace them. So it is a moving target, which if anyone obviously anyone is interested as to why it always goes up, that is why, because obviously the things that do well lose their place in the top, in the 500, and then new and coming ones come and join. So yeah, that is stocks. That is stocks. There are a few other interesting things going on. Also, like one of them being the 10-year. The 10-year not making new highs here. Did obviously break below this level we had here, which then would indicate a move down to this horizontal. Break this horizontal, then and yeah, we could draw. We could. I mean, we really could draw a horizontal in there, can't we? We could draw a horizontal in here. But what I wanted to say was I would probably be aiming for actually down to this 1.5. What is happening now though is we are getting a flattening of the yield curve, which is indicative of the fact that the market did price in wrong what the Fed rate hikes were going to be, which we basically said at the time was BS, and the Fed isn't going to be. The market's starting to price in the Fed won't be able to raise 4 times this year, with obviously the flattening of the yield curve, and yeah, that will bring these rates down as well, which will then give the Fed the actual capacity to not have to raise rates to fight obviously rising interest rates due to rising inflation. And obviously, as things start to look bad, as all the people are, as obviously massive wealth is being lost, massive paper wealth is being lost in all the crazy, like the AMC stocks and all that fun stuff, Tesla, Peloton, Netflix, all the stuff that the crazy new entrants to the market like to invest in. As that wealth is lost, obviously that money is not able to then support just spending. So if that money isn't there to support spending, then that is obviously deflationary. I wouldn't necessarily say it's going to cause deflation, but it's disinflationary, so it reduces the inflation amount. And then also another factor. And I know we have this meme in crypto about McDonald's and that. Some of these people that are living off these gains, they literally will have to go back to work. So I'm not necessarily saying McDonald's, but just generally back to work, because one of the worst inflations, obviously, for markets, for Feds, for the elites, the ones that they hate the most, and he's then sneaked in there, the elites there, because they don't care about asset price inflation, but wage inflation, guys, that can't happen. That will be relieved by people coming back to the workforce. So that is another big driver of the stickiest of inflation, which is wage price inflation, the price of labour, and that will then have a downward effect on that. So we very realistically could be seeing easing off of inflation a lot quicker than what people thought, which means the Fed can then go back to inflating asset prices in the good old driving wealth inequality fashion way that the Fed loves to do. So yeah, 10-year easing off, basically. All that just from the 10-year easing off. But yeah, break below here, then yeah, like I said, we looking at the move back down, and then we could then start to look at potentially this being a top and then moving lower in rates. Because let's face it, rates can never go up. There's too much debt. Rates can't go up. They are the 3 Ds. I think it's the debt, the disruption, and demographics. That's what it is. I mean, disruption from technology is what the other D is, and then demographics as in an aging population, which are all reasons why interest rates ultimately can't rise, and they have to go down, go negative, go well, they've been negative in real yields for a long time. But yeah, that's that. Also the dollar interesting as well, not having any significant break up at all in the face of such bearish price action in the stock market. It's indicating that that this market is kind of stuck between obviously rallying in a risk off fashion, and selling off in a there's going to be, the Fed's going to do something, the government's going to do something, there's going to be stimulus, there's going to be all sorts of fun, cool handouts, not to mention midterms coming. Obviously with inflation easing off, I don't know why I've said that twice, and stock markets coming off as well, all of a sudden the build back better bills, and basically spending bills, so basically fiscal stimulus as opposed to monetary stimulus from the Fed, fiscal stimulus from the government, now becomes more possible, probable, and at a higher amount than obviously it's been driven down to by by Manchin and all those guys that are basically worried about inflation. On the political side of things, inflation has been for whatever reason, because this is how stupid markets are. I guess it's not necessarily how, well, it is pretty much how stupid markets are. Inflation has been not stupid markets, but stupid people are. Inflation is just getting pinned on Democrats and Biden. I mean, the guy's been in office 1 year. He did not within 1 year cause 7% inflation. As much as I don't particularly like the guy, the financial system, whatever. Biden is not responsible for the 7% inflation figures. He may have had a slight impact of it, but there is very little he can do within 1 year that's going to have caused that. Those wheels are going to be have been set in motion a long time before him. So yeah, there you go. US oil price. He is responsible for a lot of this, though, I will say, because of obviously the shutting down of wells and all that fun stuff, and the opposition to obviously to fossil fuels and the push to renewables and green energy. I mean, that has stifled exploration and just production, and actually taken rigs offline, and yeah, I mean, that is obviously helping to drive that up. So he single-handedly is responsible for this, so maybe this can be pinned on him. So if you want to pin something on him, yeah, fair enough, because obviously, as we all know, Trump was getting America, inverted commas, energy independent, and they were obviously pumping out masses of oil from the shale oil, and also natural gas as well, which they were literally burning off because it was basically worth nothing, because, well, mainly because it's hard to transport and store. Yeah, at some point we're gonna have to look at some cryptocurrency stuff, aren't we? At some point. Let's just flick over to it. Ethereum Satoshi pairing, clearly our favorite indicator of risk, showing that yes, there is not a lot of risk going on in the market. There's a lot of risk off, but we are coming to an important level, so potential bounce there. The ETH USD trolleyed also straight through this level at a we're gonna have to extend some horizontals along here. At a horizontal we're at now, I'm gonna have to extend this one along. We've got another horizontal down here. And we do have another horizontal down here. Probably have to extend these along a little bit more, because I mean, we can't say these are not in play. These are clearly in play. These levels are in play. Yeah, basically 2,800 area was a big area of support, but I mean, at the end of the day, though, this is the USD value. This gets driven by where Bitcoin goes. Bitcoin is getting driven by where the stock market goes. This is why we look at this much. I mean, more important, I think, is this chart, just because it gives us something the other charts don't, because they're basically just giving us the same thing. So it's good to see the relative trade. Bitcoin dominance also right up there into our resistance area. So if these markets are going to potentially recover and turn around, it will be from here. If not, we are looking at basically what will probably be a protracted bull market in this asset, bear market in crypto, and just a bleeding out of the alts. So yeah, gold and silver, funnily enough though, not doing anything. So they are actually also indicating as well to me that this inflation narrative is gonna, I think it's hit its crescendo, hit its peak. I was even saying that before in this 10-year when we're getting around here. I was like, I don't think we're really going to go much further from here. I do think this is a squeeze higher sort of double top flush out, and then I do think we will come lower from here because, well, things are wrecked. Just look at stock markets, we are wrecked. Now let's go look at Bitcoin. Bitcoin though itself, in all fairness, $30,000 is the very important area, where I particularly think it's going to be very difficult to recover from if we start trading below there on a weekly basis. In fact, I didn't need to draw that there. In fact, that I can delete. I meant to draw it at the $30,000 level. At present, though, we are getting supported by this level here. As I've saying, we are going to be following stock markets. So if stock markets decide they want to take a nice big thick wick to the downside, or it's a thin wick, I guess, isn't it? But just a nice big move to the downside, then yeah, ultimately this is where we can. This is where we kind of got a hold for Bitcoin, kind of fully destroy structure. You guys do know I do like horizontals and channels. If this then just becomes a big channel, we hold 30,000, fine. yeah, fine. If we do break below here, not good. Obviously, we've got a head and shoulders here with a ridiculously low target that, well, we can't realistically say isn't going to play out. But like I said, we are getting dragged by the stock market stuff. If the Fed, if something gets announced, or even fiscally gets announced over the weekend, or markets bounce into Monday, then expect Bitcoin to bounce as well. We are obviously driven by external factors. Yeah, I mean, we can look at stochastics, just because we probably like sticking pins in our eyes over here. 4 hour very low, and he's still pointing down. 4 hour is not going to rescue us here. 10 hour pointing down and coming down. 12 hour still coming down. Daily turn back down, coming down. By daily turn back down. 3 day down and low. These are the ones we're talking about though. Back to our 5 day and weekly. Like I said, when these turn up, I think we would then get our significant bounce. Whether that bounce ultimately ends up in new all-time highs, we shall have to see. But the thing is, where does that bounce come from price level-wise? Is it, as we were saying, could it be down here? Could it be down 33? Could it be down 30,000? Where does the level of the bounce come from? And then clearly it wasn't at the previous level that we were at. Weekly also coming down, bi-weekly coming down, and monthly turned down as well. So obviously looking pretty bad there. The titles to these videos will turn bearish once we are closing below $30,000. So not a million miles away from there at the moment. However, like I said though, this sell-off has been pretty relentless. Price action does meander. We are going to have a significant bounce at some point. Squeeze out the shorts, the later shorts, the people that are just averaging on side with their shorts all the way down, and then try and FOMO some longs in. We will get just like you have the adage, you go up the staircase and down the elevator shaft. That is how sort of bull markets work. You go up step by step and then you come down fast. In a bear market, it is the opposite. You grind down, you go sort of down the staircase, and then you go up the elevator shaft, and you get pretty aggressive big moves to the upside. That is just the opposite of that's how bear markets work, just literally the direct opposite of how bull markets work. So yeah, even if we are going to stay in a bear market, we have to expect some aggressive moves to the upside, which will be there for selling, and then people will sell early and they will get squeezed, then people will FOMO in and buy, squeeze even more. So yeah, and don't forget there is the market as a whole, with the whole Wall Street bets thing, has come accustomed to looking for short squeezes when they can put the pressure on. So but obviously we need a lot of shorts in the market first before that. So anyway, yeah, that is the video for today. Remember, this is not financial advice. I'm not a financial advisor. Always do your own research, and I shall speak to you guys soon.